Shares of Sunnova are down over 69% over the past year. They've fallen about 50% just in the past month. So what in the world is going on with this residential solar company? Well, Sunnova is hitting the exact same challenges that a lot of the other companies in the solar industry, SunPower and Sunrun are two of the biggest names in the same field as them, have run into previously. And I think one of the interesting things with Sunnova is this was such a hot company in the solar industry that it just seemed like it took longer for the market to realize that they were in the exact same financial trouble that Sunrun and SunPower have been in. And those companies have at least gotten to the point where they have started to shore up their balance sheets. Their stocks have dropped. So now they're at much more of a reasonable investment level, potentially even at a bottom if we do start to see the market recover in 2024. But Sunnova seems to have come to that a little bit late in the game, and that is why the stock is off as much as it is. So I'm going to go through what we learned from their recent quarterly results and what the market is probably thinking, because I think the cash problem for Sunnova over the next year or two is potentially even worse than it is at some of its competitors. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go to the stock chart first. You can see that Sunnova down 69%, like I said, over the past year. The last month, the stock just cratered right here, February 21st to February 26th about. And this is when management announced that they were going to basically have an open-ended stock offering. Now, CEO did say that they aren't going to need to use that stock offering, but they wanted to have it available if it was needed. But that really spooked the market. And this follows some really dilutive offerings from SunPower and a weak quarterly result from Sunrun as well. And I'll go to some of the challenges. These are some of the operating trends. This is from Sunnova's earnings presentation. And one of the things I always want to caution investors, they make these numbers look really good, but you have to dig in to see how much of this money is actually Sunnova's, because what they're doing is they're leasing solar systems, so signing customers to a 20, 30-year contract. Those customers agree to pay a certain price for the electricity that they're getting. And then Sunnova is going to collect the tax credit, sell off any other tax equity is one of the pieces that they're going to sell, and then probably sell some of those cash flows as well. I'll get to that in just a second. But the challenge here is that as interest rates rise, the amount of money that you're going to get up front for securitizing those assets is going to be lower. So it's going to make it more difficult to finance those projects. You have to adjust your expectations as a result. I have covered specifically with Sunrun because they assume a lot of value in basically years 20 to 30 for each of these projects. And I think that's very questionable. Sunnova seems to do a lot of the same things, having very rosy expectations for what the future is going to look like. And I think we should be cautious with those rosy expectations. Here's their 2023 results: $720.7 million in revenue, $274.5 million in adjusted EBITDA. This is the metric that a lot of these companies want us to believe is kind of the way to value them as companies. Maybe a little bit questionable, but I just wanted to point out exactly what they're reporting. And here you get to liquidity. This is where I think investors are the most worried, because this is the change in liquidity just over the last 3 months from the end of September to the end of December. And the biggest drop was in unrestricted cash. So what we could be seeing here is Sunnova is not able to sell the future cash flows or the assets that they have for the value that they would like, resulting in them having to hold some of those assets on the balance sheet and reducing the cash balance. Now, in theory, the unit economics are pretty solid. Management said that there is a weighted average cost of capital of 6.4%. This is probably pretty high for thinking about projects that are going to be financed today. That financing number is probably going to be more like 8 or 9% from a debt side. So that spread is going to come down as a result, and that's where you get to the potential loss in profitability, because you just can't sell those upfront cash flows for as much as it costs you to actually build these projects. And that was the way that a lot of companies were financing themselves. This is the one that I really wanted to get to, because I think this shows just how optimistic management is being about the business. So they're saying the levered cash flows from the business, $140 million. This is, and they give the number right here, the sum of expected residential residuals from securitized customer leases, PPAs, and loan contracts, plus all MSA fees, and inflows from unpledged SRECs and grid services. So these are residuals from projects that were signed in the past. Investments in solar systems, $4.25 billion, proceeds from tax equity, 1,500 net borrowings from non-recourse debt. This is going to be asset-backed securitization and warehouse facilities. This is basically the financing of all of these projects, financing that future cash flow, $2.7 billion. This is really the number that we need to scrutinize, because if interest rates go up, this number could go down to $2.4 billion. Now suddenly you have to come up with $300 million. And guess what? Even their optimistic scenario here, their net change in cash is zero. So they're assuming that they're going to be able to finance $2.7 billion worth of projects at an appropriate interest rate. And even if they can do that, they're not expecting to have any cash generation for the business. So that's kind of a red flag for you as an investor. And then you look out to 2025 and 2026, you see some similar trends, expecting to be able to finance projects to the tune of billions of dollars. Might be able to do that, but what we've seen lately in the industry is that as these companies have had to increase their prices to be able to actually make money on these projects, because they're trying to securitize and sell all these future cash flows, their volume is going down. This is the trade-off that they have as a business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So really, Sunnova and a lot of these solar installers, Sunrun and SunPower, are going to fall in the same category. Their leverage plays on the growth in the residential solar industry long term. And so there's a lot of dynamics that go into it here. But if interest rates keep rising, it's going to be harder and harder to make money on these projects, with all else being equal. So under that scenario, I'm not assuming they're going to be able to raise prices on customers, or their costs aren't going to come down. But if just interest rates go up, that's going to be bad. But if interest rates go down, then that could be bullish for the industry. You get a little bit more spread or margin for each of the projects that you're building. The two things to watch in 2024 is, do we see some reductions in costs, in installation costs? That's one of the things that all these companies have talked about, trying to reduce their costs, whether that's solar panels, installation, racking, inverters. There's all kinds of component costs that could be reduced. And so I think we'll start to see some momentum on that. The question is, does that offset some of the higher costs from higher interest rates and labor increases and inflation, things that we saw in 2023? So there's going to be a balance there. But then the third thing is, are you able to increase your prices and at the same time grow the installed base? This is really the fundamental problem. As interest rates have gone up, all of these companies have to raise their prices, the amount of money that they're charging on a per kilowatt hour basis to their customers. And if they can't do that, then their margins are going to get squeezed. But if they raise their prices, their volumes are going to go down. This is the major challenge. And at the same time, we have net metering 3.0 happening in California. That went into effect about a year ago. But it takes a while for that to actually impact a lot of these companies' income statements. And that's what we're starting to see some of these installations drop at a pretty rapid rate in California specifically. So if that market starts to recover, we get any sort of policy changes, maybe customers are willing to pay a little bit higher price. I know a lot of them are including battery energy systems. Companies are doing that across the board. So that could be a tailwind for the industry. But this increased risk is why Sunnova is dropping the way that it is. It's falling along with a lot of these other solar installers. So something to keep an eye on. Could have a recovery in 2024, but also could be another bad year for the industry. What do you think about residential solar stocks? Leave your comments in the comment section below. Thanks for watching. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.